Extended market outlook. Analysts warn of potential further downturns amid economic uncertainty. In a recent rebound, stocks managed a modest recovery from their slump on Monday, but the relief could be short-lived. JPMorgan's chief market strategist Marko Kolanovic, along with other Wall Street bearish strategists, signal that the challenges facing the stock market are far from resolved. Investor concerns persist as expectations for Federal Reserve rate cuts dwindle, inflation continues to stick, and stock valuations remain high. These elements combine to create a market environment akin to the prelude of the three-month downturn witnessed in the late summer and fall of 2023. It's a scenario that suggests the potential for a recurring pattern of market corrections. Persisting challenges and economic analysis. According to Kolanovic, there might be a temporary stabilization based on upcoming quarterly earnings, but the broader outlook is not as promising. Beyond this, however, we think the sell-off has further to go, he noted in his recent analysis. He outlined several pressing concerns, including continued complacency in equity valuations, inflation staying too hot, further Fed repricing, and a profit outlook where the implied acceleration this year might end up too optimistic. This perspective draws parallels to the market conditions of last year when unexpected rises in inflation and hawkish shifts in Federal Reserve policy led to significant market adjustments. Current market narratives and patterns increasingly mirror those times, with investor positioning now appearing even more elevated than before. Federal Reserve's role and market reactions. The market's response to Federal Reserve policies has been a focal point. In the late summer of 2023, skepticism grew around the likelihood of rate cuts following Fed Chair Jerome Powell's indications that interest rates might remain high for an extended period. This stance significantly impacted stock valuations as bond yields surged, leading to a noticeable downturn. This year, while there have been no direct suggestions from Fed officials about further rate hikes, the unexpectedly robust economic performance has prompted some economists to propose that rate reductions might be off the table for the year. This adjustment in expectations has catalyzed a sharp increase in bond yields, with consensus shifting dramatically, from anticipating as many as 7 rate cuts at the beginning of the year to now expecting fewer than 2. The 2-year Treasury yield recently hit a significant 5% level, reminiscent of the peak last November, and has become a critical indicator for assessing investor sentiment. Julian Emanuel from Evercore ISI highlighted, "We're seeing similar market dynamics as those that led to last year's pullback, with the 2-year Treasury yield being a pivotal metric. This yield's movement has been closely watched, as its increase to nearly 4.97% on Monday underscores the heightened sensitivity of the market to interest rate expectations." Looking ahead, market strategy and investor sentiment. As the market grapples with these complex variables, the focus now turns to how upcoming earnings reports and further communications from the Federal Reserve might influence investor strategies. The insights from these earnings and Fed updates are expected to be critical in determining whether the stock market can sustain its precarious stability or if it succumbs to the pressures hinted at by strategists like Kolanovic. Investors and market observers are therefore advised to maintain vigilance, watching for any signs that might indicate shifts in economic indicators or policy directions that could impact market trajectories profoundly in the upcoming months. The interplay between economic performance, Federal Reserve policy decisions, and investor sentiment will undoubtedly shape the market landscape, demanding a strategic and informed response from all market participants.